Greetings learners, welcome to Inno Chronicles. Today, we dive into the fascinating world of economics, exploring the Reserve Bank of India's arsenal in managing our economy. Picture this, inflation and deflation are like two mythical beasts, one breathing fire, the other breathing ice. Too much of either can wreak havoc on the economy. Now imagine money as water in a river. Ideally, we want a steady flow, not a raging flood or a bone-dry riverbed. To tame these beasts and maintain the flow of our river, RBI uses a variety of tools. First, we have the cash reserve ratio, or CRR. Think of this as a dam at the source of our river. By increasing the CRR, RBI can reduce the amount of money available for banks to lend, cooling the fire of inflation. Conversely, decreasing the CRR releases more money into the economy, combating the icy breath of deflation. Next, we have the statutory liquidity ratio, or SLR. This is another dam, but it's situated downstream. Banks are required to keep a portion of their deposits as safe government securities. Increasing the SLR reduces the funds available for lending, further fighting inflation. Decreasing the SLR, on the other hand, releases more funds into the economy, stimulating economic activity. Then, we have the repo rate, the rate at which banks borrow from RBI. Increasing the repo rate makes borrowing more expensive, slowing down the flow of money and keeping inflation in check. Decreasing the repo rate makes borrowing cheaper, encouraging loans and stimulating economic growth. The reverse repo rate is the rate at which banks park their excess money with RBI. Increasing this rate encourages banks to park their money, reducing the flow of money and controlling inflation. Decreasing this rate discourages parking, pushing banks to lend more, thus boosting the economy. Finally, we have open market operations, or OMOs. Here, RBI acts like a water vendor, buying and selling government securities. When RBI sells securities, it absorbs money from the market, reducing inflation. When it buys securities, it injects money into the market, stimulating a sluggish economy. To summarize, during inflation, RBI tightens the money tap by increasing CRR, SLR, repo rate, and conducting OMO sales. During deflation, it loosens the tap by decreasing these rates and conducting OMO purchases. Remember, RBI uses a combination of these tools, adjusting them based on the current economic situation. It's a delicate dance, but mastering it keeps our economic river flowing smoothly. Think of yourself as a captain navigating this river. Use the right tools at the right time to reach your destination, a stable and prosperous economy. Have any questions? Don't hesitate to drop them in the comments below. Remember, this video serves educational purposes only and does not constitute financial advice. Join us next time as we continue our journey through the fascinating world of economics. Until then, keep learning.